Hello, and welcome back to Equity, TechCrunch's venture capital podcast. I'm TechCrunch reporter Kate Clark, and I'm joined by my co-host, who has recently joined the esteemed ranks of the TechCrunch Boomerang Club. Hi, Alex Wilhelm. How's it going?
It's going well. I've always wanted to be a sports implement, so I'm glad to be a boomerang. I've been back for like a week and a half, and it's been surprisingly easy to come back, actually, in a really nice way. People have been really kind, and hopefully I'm writing some good stuff, so I'll just kind of keep running as fast as I can.
We're so happy to have you back. You've already written like 1,000 posts, probably like 20 actually. Probably written 20 at least.
I counted because I saw that in the script. I've written 21, so dead
wow.
on.
You are on pace. I can't do that quick math, but you're on pace to write like 1,000 posts this year, or 2,000 posts probably.
I don't know. I haven't done the math yet. I feel like we're in this weird holiday cycle when I keep waiting for the news to stop, but there's been so much of it that I've felt like I've had to kind of move faster than I expected to. Like I thought a week before Christmas, it was going to be kind of dead.
Yeah, you're right. It's actually been pretty busy. I think it will die down next week. I remember last year around Christmas time, trying to find things to write about and having to write a post about how Bitcoin was struggling. And I do not cover crypto, and it's just like desperate to write something.
I've not had that problem this year. I mean, people are announcing funding rounds still. There are big deals coming on. There've been some acquisitions. I mean, we have an entire section of new funds coming up. So, so much for a slowdown. But before we do that, some housekeeping notes for everyone listening in, which is, it is the holiday season. Equity is here this week. We are going to be off next week. We are taking a 1-week hiatus because we are tired. But we will be back right when the new year begins. I think we'll be back January 3rd, if my memory holds up correctly. So fear not, Equity will be right back with some cool stuff. And then we turn 3 in March, I think it is. So a lot of good things coming up that I'm pretty stoked about. But other than that, Kate, I think we can just dive in, yeah?
Yeah, let's dive in.
All right, so you're going to kick us off with a trio of new funds that were announced this week, back to the point that news is crazy.
Yeah, there were at least 3 new funds announced yesterday, yesterday being Wednesday, probably more this week in total, but we're going to talk about 3. The first one is Tusk Venture Partners, which is a venture capital and political consultancy firm that Bradley Tusk launched in, I think, 2015, I want to say. I'll double check that. But the firm raised a $70 million second fund. Yeah, they're behind companies like Bird, Row, which is the healthcare company that sells erectile dysfunction medication and some other stuff as well, and Coinbase, which is the cryptocurrency exchange.
Yeah, a pretty impressive list of companies from a firm that raised a $36 million initial fund, which it's a lot of money for like you and I, as always, but it's not a lot of money for a venture capital company. So to see them go from 36 to 70, given that initial set of companies, not too surprising. I'm kind of curious about their competitive edge, because if I recall correctly, and tell me if I'm wrong, the real calling card for Tusk Ventures was political connections and kind of political savvy. Like, they had a lot of connections to people in DC, and so that was going to help startups navigate those waters. I'm curious if that holds up as an investment thesis.
Yeah, I mean, I think it's doing. I mean, clearly, because they are doubling the size of their debut fund, they are doing well, and we're able to make the case to LPs. So Bradley Tusk was served as the campaign manager for Mike Bloomberg as deputy governor of Illinois and as communications director for Senator Chuck Schumer. He also wrote a book called The Fixer: My Adventures Saving Startups from Death by Politics. The reason why they are able to land deals with companies like Coinbase and Bird and Row is these are companies that might have regulatory barriers, and they can offer their expertise there. So actually, it makes a lot of sense, because now that VCs these days are trying so hard to differentiate themselves, they have kind of this natural differentiation, which is politics and a political savvy that you're not going to get from really any other VCs. So it makes sense that they could get in some big deals. I don't know what they've been doing recently as far as like landing some new really hot companies. Obviously, Bird was sort of the hot company of 2018, but less so in 2019.
Yeah, I mean, there's a lot of money in the market. They have a good place to fit in, I think, based on what you said. And just keep in mind that the political landscape for tech has changed dramatically in the last 3 years. Tech used to be this kind of like golden child. And I really want to say, since Facebook really started getting beat up and antitrust fears began to rise again, regulatory concern has, I think, trebled or quadrupled in and around Silicon Valley. So that could help drive deal volume. But let's scoot on to Sapphire Ventures, which is the former corporate venture arm of SAP, the German kind of enterprise software giant. And this has a new fund, which is 1.4 billion. Kate, is that right?
Yeah, they've raised 1.4 billion. It's kind of across a couple, maybe even 3 different vehicles, and basically a main growth fund and an opportunity fund, so they can make really big investments in the most promising companies, or they can reinvest in some of their most promising portfolio companies. So Sapphire Ventures used to be part of SAP, and interestingly, they did spin out in 2011, and they're fully independent, which is interesting because you don't see that very often. And the reason you don't see that is because there's so many perks to being a corporate venture fund, which is that you have you can have unlimited capital because you're investing off the corporate's balance sheet or the corporation's balance sheet. But they decided to go fully independent, and now they have nearly $4 billion in assets under management.
I'm kind of curious if they're one of the most successful corporate venture funds of all time, kind of post spin out, because I can't think of another CVC that has spun out that has raised that much money.
I can't think of another corporate VC that did spin out because I just don't know that that's the most common. Although Intel Capital or Dell has something. I think it's internal though.
I mean, a partial spin out would be like GV from Google. But that's just landed inside the broader Alphabet family, so it wouldn't quite fit. But to see them raise 1.4 billion, super impressive. It's late stage money, like it's it's the end of 2019. I'm surprised always when people raise over $1 billion to put to work now, but that's probably why I'm not a VC. But the coolest new fund this week was Moxie, MOXXIE, which has an interesting kind of single GP. Is that right?
Yeah, the fund was launched by Katie Jacobs Stanton, who's known best for co-founding #Angels, which is an investment collective. I think it's 6 women, and they independently invest their own money, but they share deals, to help each other land some really awesome companies. And she's invested in a ton of companies while being at Angels, and her own portfolio includes companies like Cameo, Carta, Coinbase, Lambda School, Modern Fertility, and more. And I really enjoyed talking to her. She was really open about the experience. And, she said even though she's clearly, well, she didn't say this, but even though she's clearly got a great reputation, it still took her 6 months to fundraise. And she said she had to reach out to, I think it was like 270 people before she was able to close what became a $25 million debut fund.
That is a lot of no's or a lot of babies or a lot of laters. That's oof.
Yeah.
I'm glad I don't do that. $25 million is a lot of money for probably one investor to have, because certainly she didn't have that much capital beforehand, so she can do a lot more work now. But one thing we've seen as a trend in this case is that VCs were often kind of the LPs in this fund. And we were talking before the show, and you said that's becoming the norm, but it's not about deal flow, which surprised me.
Yeah, I've noticed a trend in 2019 of a lot of people raising small venture capital funds. This is not, this is not a tiny fund, but it's in the grand scheme of things, it's quite small, and it's great. It's a great debut effort. But yes, a lot of the LPs in these funds have been venture capitalists, people like GPs at Andreessen Horowitz or GPs at Sequoia, or it's people like that who have plenty of money to invest, and they're doing this to foster better relationships with some of these up and coming venture capitalists. Katie is not up and coming, she's certainly established, but people like Brianne Kimmel, who launched a $5 million fund, I think maybe 2 months ago. She had a majority, I think, of VCs in her LP base, which is interesting. I think we'll see more of that. I think we'll see a lot more of that actually next year. There's sort of this rise of angels turned kind of like these mini institutional VCs, and there's a lot of perks to doing it on your own, I think.
Well, I mean, one thing you don't have to do is rise through the ranks. I mean, one thing people don't always remember is that VC firms have incredibly low turnover. And so there's not a lot of slots that open up the hierarchy. And so you could possibly maybe join a fund as an analyst or an associate and kind of grind your way up over 15, 20 years. Or if you can just go raise 25 million, 20 million, 15 million, whatever, you can go just do it yourself and become top of the pyramid. So I think that's probably partially why we've seen so many micro funds come out. My question though is, when the eventual correction comes, and there is a downturn, business cycles always happen, how many of these nano, quantum, micro, pico, whatever the prefix is, funds survive with a reasonable return and raise the second block of capital?
Yeah, right. Because I say the second fund is the hardest to raise, because raising a small fund kind of with this exciting, innovative vision that maybe these LPs have never heard before, or a new exciting space, like with Brienne, where she's focused on kind of future of work, where there are not that many VCs that are exclusively investing in that space. I can see why that would be an exciting opportunity. But yes, the second fund is really difficult, and the third fund as well, and kind of making your way to, like we've seen Samil Shah do with Haystack, like really making your way into the bigger leagues of VC and kind of proving that you can do it on your own. We'll just have to wait and see.
Yeah, I mean, it's funny that you kind of put it that way, because there's a trend in music called the sophomore slump, in which people's first album is amazing, and then their second album is not very good because they've had 20 years to write the first one, and then they have 18 months to write the second one. So it's so compressed that they get they kind of stumble. So it could be a similar idea. But one thing I like about #Angels, going back a little bit, was that they were getting more women onto cap tables in general. Mm-hmm. And one thing we've talked about a lot on the show over time has been gender diversity inside of both the venture capital world and also in money dispersed by the VC world. And there were some new stats that you pulled out that generated some kind of weird drama in your life around a headline. And I wanted to ask about that, because I'm curious what kind of feedback you got from the post you wrote about how much money female founders.
Yeah, so I did cover. I've been doing this the last few years, like writing up at the end of the year how much capital was invested in female founders, and I use PitchBook as a data source. And the latest is 2.8% of capital invested this year went toward companies that were founded by women. So that means not mixed gender, but that means exclusively women founders. So like maybe 2, 3, 1, whatever it is. When you look at mixed gender, I think it's something like 11%. Anyways, I titled this article, U.S. VC investment in female founders hits all-time high, which is true. But some people didn't like that I decided to headline the article with something positive when, in fact, these are abysmal statistics, which, is very clear given that 2.8% is just microscopic. But yeah, so there was a lot of backlash over that, which I found interesting, because in the past, I've written dozens of articles about the gender funding gap, I guess, specifically. And I've noticed that people are really critical when I am too negative. So I was intrigued that by being positive, I was getting just as much criticism, both like in DMs and in emails. And there was one in particular where someone said it struck her as paradoxically indicative of the slow progress being made in the industry towards gender parity. And I guess it's just, I'm curious what you think, but it's tough in these situations, because it's like, you want to be just as objective as you can be.
Yes.
And of course my headline was fact, but, and yet.
It's really funny when we talk about stuff like this and you mention emails and comments that you get, because I get far fewer. People just don't criticize what I put out as much. And I don't think, to be clear, I'm not saying that anything I do is better than yours. In fact,
no, I know what you're saying. It is interesting, because I get a lot of feedback, which I actually really like, and I really appreciate it. I remember I was talking with another colleague here at TechCrunch who is male, and he said that people never DM him when they have sometimes I'll have a minor typo in a TechCrunch story, and I will get a DM immediately, which I like. But he said that never happens to him, which I thought that was interesting too.
Maybe he writes really boring stuff. You never know. But I do think women get a lot more comments. People feel much freer to criticize women online. And this has been a trend we've seen in social media. It's definitely true for journalists who get attacked and harassed a lot more. I'm disappointed that you were given this level of opprobrium. I don't think you made any sort of mistake, because you had to put this stuff into context, and you only have so many words available in a headline. You can't give all the nuance possible because you have a limited amount of space. That's the problem with headlines.
Right.
They're short by definition.
Totally. I could have said US VC investment in female founders hits all-time high, but is still very low. But and I think another thing that I received via email, somebody saying that I was discouraging groups of women from even trying to jump in. And I have had that exact thing said to me when I've done stories where the headlines sounded a little more disappointing, like upsetting about the stats. So I'm just kind of like, whoa. I think if anything, saying it's hitting an all-time high would encourage women. So I don't know, but it's kind of like, well, I don't know what you're trying to. It's not the most constructive feedback.
I mean, damn the haters, full speed ahead is my take on this, because I think your post was fine. But let's highlight a couple of other stats while we're here on the topic. First Round put out an interesting kind of state of startups 2019. Shout out to Alex Marshall over there. She's great. And what this included was a stat that we thought was pretty interesting, which was that 70% of female founders felt their gender hurt their ability to fundraise. So that is really high. And I trust them to be correct on that. And so I'm disappointed that the industry is still at a point in which that high of a portion of women who are raising money view that as an impediment. I forget, do they give us any historical context on that figure, Kate? Is it gone down or up?
You can look, if you go onto the site, you can look at past years. I didn't do that, but my guess is that that's probably staying somewhat steady. One thing that's worth noting is that 80% of the respondents of the first round survey were male. So, which is fine. I mean, actually, that's probably somewhat representative. So that's, it's just it's a healthy sample size. But like when you're looking at these questions like that, it's kind of interesting to see. One thing I liked was that, keeping in mind that it was 80% male, there was a question about how important is diversity at your company, or how important should it be? And I think 80% of people said that it is. So which to me, I just read that as like, oh, all those guys are like thinking diversity is important, which is good, since it's like that was like 700 men and like 100 women or something. Or that would not be the right math, but you get what I'm saying.
I get what you're saying. It's somewhere there. I think there's encouraging trends in some of this data, but the absolute numbers are still ridiculously small across the board, and often or too high in the case of the percentage of women who think their gender is an impediment. So I think what we say, I think every year, is let's see faster progress next year. I think so.
Sorry, one thing also unrelated to gender diversity. I liked the part of the state of startup survey from first round that talks about how many hours of sleep people get and then how many hours they work in a week. So 40% of people in startups work like about 60 hours a week, and then 40% get about 7 hours a night, which sleep is actually, I was surprised. Most people seem to be getting a healthy amount. 7 hours, I think, is fine. If you look at this survey, 15% of people are working 80-hour weeks, 30% are working like 70-hour weeks, and 40% are working 60. So like basically everyone is working between 60 and 80 hours a week, which is quite a lot of hours.
Yeah, but I don't think this is indicative of all startup employees. This is, 950 people that are founders, and I would presume more senior-ish employees. And it's certainly true that at a startup, if you're an exec, director, anything in that level, you're going to be working a lot. But if you're,
80 hours a week is a lot of hours. Just saying. Whew.
It's a lot of hours. There's not a lot of time in life for a startup, sleep, and anything else. You can kind of.
How do you work 80 hours a week and sleep 7 hours a night?
If you did nothing else, maybe.
I guess, yeah. Ugh.
Yeah. One more data point before we move on is that our friend Natasha Mascarenas over at Crunchbase News put together a pretty cool chart. And the number of female-founded companies that reached unicorn status reached an all-time high in 2019 at 21, which is up from 15 in 2018, and then single digits in preceding years. So while some of the numbers are disappointing and kind of sad to see, this one is a bit more positive, and it's nice to end on a high note. So I covered around this week. A company called Prague Perfect put together a $13 million Series A led by Anthos Capital. And if you're not familiar with Anthos Capital, don't worry, I wasn't either. But I did a little research, and they were actually one of the investors that put money into Honey, which is that browser deal plugin thing that I think PayPal bought for like $4 billion, blowing everyone's mind. And then it turns out, though, the connection here for me that's kind of fun is that I actually know one of the founders, Dan Winding, from my back in the Chicago days when I was in that tech scene. So it's kind of fun to see someone that I haven't seen for a bajillion years and to reconnect with them. Short version of what the company does, they do autonomous end-to-end testing for kind of web environments. QA is hard. They're making it easier. And their goal is to kind of have a pretty neat kind of system that lets you do a lot of the testing without spending a lot of your development resources on that. And then just a couple more quick data points on this. They used to be in Boston, which is near me. They moved to SF, and now they're kind of remote first, and they're at 2 million ARR, give or take. So I'm presuming they're going to shoot for like a triple in 2020, probably shooting for like 6 million ARR.
Triple. Wait, please read what you have written in the script.
Well, I wrote in the script, triple, double, LMAO. give or take. And that's why you don't read your notes out loud verbatim, Kate.
But I liked it so much.
You do, but you know what the triple, double, double, double is, right?
No. Is this something I should know? Is it a sports reference?
It's not, no, it's a venture capital reference. It's not sports.
What is it?
So the high watermark for kind of fast startup growth to reach 100 million ARR within a certain time frame, you should, quote, quote, triple the first year, triple again the second year, and then double the next 3 years. And if you do that, according to the math, you'll hit 100 million ARR.
But it says double 4 times.
I was making a joke in the notes for myself because I was in a good mood.
So your joke was you added an extra double to the triple, double, double, double?
Yeah, and then I wrote LMAO with like 6 O's, 2 of which are capitalized.
Okay, well, thank you for teaching me that reference because I should probably have known it.
Anyways, the CEO also noted that it's good to have a stockpile of money. They have plenty of capital going into 2020. All right, good. Let's talk about Pepper, Kate.
Pepper. So Connie Loizos wrote a story this week about Pepper, which is a new startup that raised $5.6 million in seed funding from Upfront Ventures, which is that LA firm behind Bird and a bunch of other companies. Lower Hippo, it's a New York firm, and Manta Ray Ventures, which I am not familiar with, but is a venture capital firm that invested. So they help direct-to-consumer startups and other digitally native businesses better predict and understand how every investment they're making impacts the future health of their business, i.e. they help startups not overspend. How they do that, I'm not totally sure. I didn't cover the company, but I think it's interesting and kind of reflective of the state of startups right now. There are so many companies with so much cash getting blown into them by big funds that they don't necessarily know how to spend, and then they potentially do overspend too fast, and they run out of money. And we've seen that happen a lot, and a lot of companies shut down because of this. And in the era of SoftBank, when they will give you $300 million when what you really need is $7 million, it's probably worth it to pay a company like this to help you out. Though, can this company survive in a different environment? I think not.
It depends, I'd say. I hear your point. I don't think you're heading the wrong direction. But the question is, how much money can they really save people? Because if they can go into a company that's spending X amount of money on Facebook ads and Instagram ads and Google ads to drive new customers or new sales, and they can save them a material percentage, that might actually become more important in a downturn because everyone's desperate to save money. At the same time, you're totally right that spend will probably fall dramatically, cutting into their possible revenue base. So I can see it both ways.
I think in a downturn, if we actually have one, I think that these startups that cater to other startups will be some of the first to suffer. Even if they're providing services that are helpful and money saving, I still think that a lot of companies will hire internally instead of paying a bunch of other companies to do some of these things. And I think that's probably what will happen. Right now, it's a great business model. We talked about this a lot on Equity. We talked about it a lot during the YC days because so many companies coming out of YC were startups serving startups. And I think it's really great in a frothy market. It's very smart and it works really well. But you think you need to have other opportunities for customers for that to work in a different funding environment or different financial environment.
Yeah, the last thing we'll throw into this little round is that one thing we've seen in a number of startup verticals, like neobanking, for example, is rising CAC or rising CAC, which is customer acquisition costs. Mm-hmm. And so as a lot of companies compete for the same channels, Instagram, Facebook, and Google being the big three, you can end up competing and overpaying for clicks and overpaying for new customers. And so this company is founded by these Snapchat or Snap former Snap people.
Yeah,
I think is the correct way to say that. And so they probably have a pretty good view into the social media marketing space. So hopefully they can reduce some spend and save people some money, especially in the D2C space. I'm excited about it. I'm curious what happens when the market falls apart. But they have $5.6 million more, so we'll see what they do. And that brings us to the last thing today, Kate, which is kind of a series that I've been working on, for lack of a better term. I was onboarding last week. Here's the backstory. I was onboarding and I was really tired of it. And if you've never onboarded to a Fortune 15 company, there's many things you have to do to get your technology even just turned on. That's and true. I had passwords written down all over the place, and I was trying to get phones to link up, and getting computers on Wi-Fi was a huge hot mess. And I finally got kind of stable. And so I decided to write something. And I just wrote a piece that kind of summarized some stuff that I had seen while I was offline, which is that a number of companies had announced this $100 million ARR threshold. Surprisingly, it got a big reaction. My whole point was that I was curious why we still focus on unicorns as like the cool kid club in the startup world when there's like 500 of them. So it's not really special anymore. And so what if we talked about these companies that have hit kind of 9-figure recurring revenue in this example, but I would take trailing as well if you're not in the software space, for example. And then a couple companies that I talked about initially was Asana, Druva, and WalkMe. And then a bunch of people reached out, and GitLab will hit 100 million ARR in January. And then Ignite, Braze, and O'Reilly have also crossed 100 million ARR threshold. And I have some more companies coming up that are also going to be at the threshold. So people have been kind of pinging me about this. I'm curious, from your perspective, if you were redeciding where you would draw the line around what startups are kind of cool and hot, putting valuation aside, what would you pick as like the metric?
I think that the best metric would probably be ARR. I did somewhat facetiously tweet a while back that I didn't think a company should be considered a unicorn unless they were valued at more than $1 billion and also profitable. But I know that you can't be profitable if you're prioritizing growth and blah, 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 blah. I understand. People just were like, yeah. So that I understand. But it was more it was kind of just sort of saying that our current metrics of considering companies a quote unquote unicorn when they're valued at $1 billion isn't really the most effective anymore, because there's like hundreds of these companies becoming that way every year now. And it used to be like there were 65, and I think there's now like 2,000. It's just crazy. So probably something like this, in annual recurring revenue, and just kind of showing that they actually are making money is a really good way of going about it. But the thing is, companies don't want to share that data. They do want to share their valuation because it means nothing.
Yes.
So
it doesn't tell you really what's going on. And so digging into what you just said, though, I think the profitability point is very interesting, because you're really asking about kind of quality of revenue and then cost of business, which is kind of will net out to profitability. And a friend of mine, who I'm actually going to hopefully cite in the next couple of days if I can get enough stuff done before Christmas happens. Christmas is poorly timed this year. I have so much to do. Stupid holidays. He was arguing that just this focus on ARR was stupid, because you can spend $1 billion getting to $100 million ARR really inefficiently if you wanted to. Why not take a look at some kind of standard SASE stuff like CAC to LTV ratios, CAC repayment time periods, all that fun stuff. And I had the same reaction you had, which was no one will tell me that. If I ask the average Series D startup, what's your CAC repayment period on a blended basis, they're going to be like, well, go fuck yourself. Like, we're not going to tell you.
Although not that many reporters are going to ask that specific question. So, I mean, like a lot of the tech reporting is not so in depth on financials. And we've actually talked about this before. I think like you prioritize that more than I do in your reporting, and that, which I think is great, but like you're interested in these things that like maybe some other reporters might not be as interested in, because you are such a lover of like financials. And also, I was reading one of your stories this week, and I don't remember what it was, but you had a screenshot of, it was a screenshot of like a earnings report or something. What was it? And you had red arrows. Like you had red arrows in it. Did you do that? And I wanted to know did you put the red arrows in there yourself?
Oh yeah.
Oh, I was laughing so hard because I just knew you did that. You were like sitting on your computer, like adding. Chris is laughing. I can't explain it. I wish people could look at it as I'm trying to. I'll put a picture of it in the equity post.
If you're watching this on YouTube, Chris will put it up on the screen now, so you're seeing it. What I did was I took a screenshot of this company's income statement. It was a hot mess. It was UCommune, this Chinese WeWork knockoff catastrophe, and I was pointing out that it's gross margin negative. And if you don't know what that means, it's bad. It's very, very bad.
Big red arrows.
I put with the on Mac, if you take a screenshot, you can add like little blocks. I just added 2 fat arrows, like revenue, cost of revenue. Because no one knows how to read these things. So I was like, I'll help.
No, that was actually really smart. And that's true. People don't know how to read them. So it's helpful to highlight. But it was just the most Alex thing I'd ever seen. I was just like, couldn't take it. I don't know how I got to that. I think I wandered off topic a little bit.
Oh, no, you're totally fine. Anyways, the point is valuations are overdone. ARR is cool. There are better ways to think about startup exclusivity, but no one will tell us those things. So we have to find the middle point between what we actually want to know and what we do know. And we've decided that it's roughly ARR. I will name this group of companies eventually, probably Centaurs or Centurions or something like that. But
Centaurs and centurions? What?
Well, it means 100, right?
Wait, what's a centurion though?
That was Alex Conrad's idea from Forbes.
Oh, okay, cool.
anything with a CE and T prefix will kind of work, but like centipede sounds mean. So
I like centipede. I love that. Let's do that.
You want to step on too many legs?
Everyone's going to get so mad if that's the new term, because unicorn is so much more majestic and fantastical.
Yeah. I want people to actually use it. So if I pick something that's like a joke and mean, it'll just be me talking to myself in the corner. That's no good.
Okay. Well, brainstorm and get back to me.
I will brainstorm and get back to everyone. I'll put it on the website. But in the meantime, we should stop. Kate, as always, a delight to talk to you. And I hope you have a really, really lovely holiday week.
Merry Christmas.
Merry Christmas.